When we think of stock market falls, we tend to concentrate on the really big ones, usually crashes that we ourselves lost money in. But in fact, most market falls aren't really crashes at all.
There are broadly three measures of stock market valuation falls. So a correction is normally accepted as where the market falls 10% in a very short space of time. A crash is when the market falls 40% or more from its previous high. And a bear market is broadly expected to be around about a fall of 20%. But a bear market can be a succession of corrections or a succession of crashes. So in other words, one is a temporary fall from previous values of a small magnitude, and one is a very large fall. But a correction or a crash doesn't necessarily say that that is the direction of the market. So just because we have a correction doesn't mean we're falling, and just because we have a crash doesn't mean we're continuing to fall. It may be just a temporary blip and then followed by a rally.
Proper stock market crashes, like the 1929 crash for example, are actually very rare. Markets can go 10 or even 20 years without one.
In my lifetime, I've seen 1974, 87, the 2000 was the dot-com crash, and I've also seen 2008. And all those have been proper crashes where the market's gone down more than 20%. But for example, in 1987, the market went down in October more than 20%, but by Christmas had recovered, it hadn't lost over the year. So what looks like a crash may actually not be a crash. It just depends on what period you're looking at to define the crash.
So when stock markets fall sharply, say 4 or 5 percentage points in a single day, it's far more likely to be a correction than the start of a market crash. Fewer than 20% of corrections turn into a full-blown crash, and they're often very short.
Volatility returns to the long-term average incredibly fast. Typically, it takes a very few months and often takes only a few weeks for volatility to revert from a spike, which might be very large, to the long-term average, which you can see on the chart as a horizontal line. And there are even occasions where that volatility has returned all the way to the average within 7 days, is perhaps the fastest, and halfway towards the long-term mean within 1 to 2 days. That's about the fastest that has happened.
Some will last hours, some days, some months. Very hard to predict. Many will revert very quickly. And that's also a big lesson for investors, which is don't try to time a correction. You will not be able to forecast exactly when the correction happens, and you will not be able to forecast exactly when it reverses. So the lesson there for investors is very clearly, don't try to time. Try to ride it out. Have perhaps a little bit of extra liquidity on the side you can pour into stocks if you think the market is low, but don't try to time the correction.
What then should you do when markets fall and you're worried that they'll fall further still? Well, the best advice is to be prepared for market falls in the first place and to ensure that you aren't risking more money than you can afford to lose. Once prices have fallen, it's too late to act. By reducing your exposure to equities or bailing out altogether, you're effectively crystallising your losses, turning paper losses, if you like, into real ones.
So the general advice, I guess, is to try to have a long-term perspective in financial markets and try to sit out these market volatilities. Turn off the TV, turn your attention to something else, and try to look at the big picture. Of course, it's much easier said than done. If you play the short game in financial markets and try to buy and sell within very short periods of time, you're often poised to make terrible mistakes because, again, it's the human mind. It's not wired to make these sorts of decisions. So it's much better in the first place to have a long-term investment horizon. And once you have a long-term investment horizon, then try to relax and turn your attention away.
Again, don't wait for a crash or correction to happen before you think about these things. If, for example, you're about to retire or you're going to need access to your money in the near future, it's important to feel comfortable with the level of risk you're taking. But if you are comfortable with your risk exposure, don't be alarmed when volatility strikes. Remind yourself that you've planned for it and ride out the storm. It could be over before you know it.